Hey guys, thanks for tuning in the station. My name is Max Convexity. I got a good one for you today. It's called Are You an Enlightened Option Trader? All right, so let's discuss what it means, in my opinion, to be an enlightened option trader. So I talk to folks all the time that think that the ultimate thing to do in options is just sell premium all day long, covered calls after covered calls, short puts, iron condors, whatever. Just sell that premium. Let the odds work in your favor. People know that generally option sellers have a higher chance of profit. So I think this is a good place to start, and I agree with most of that, but not all of it. I think it's a little bit more complicated than just selling options. In my book, the enlightened option trader needs to know how to use the entire playbook. So in football, you can't just run the ball up the middle every single play and expect to win the championship unless you're the 85 Chicago Bears. In sports, sometimes you have to take a chance. You have to throw the deep ball. You have to swing for the fences if you want to win. You have to shoot your shot, right? Just like in life. I equate writing option premium with running the ball in football. Now, buying premium is more akin to passing. When a team's effective at running the ball, they have lots of plays for small gains. On the other hand, teams that pass a lot, especially deep passes, are less likely to have as many small gains. As we know, throwing the passes, even though they have a lower percentage of working out, they tend to go for bigger gains when they do work out, kind of like buying options. In options, giant gains can come from buying premium. When you sell premium, you can only earn the cost of the option. In other words, you can only make 1x. If you sell an option, it can only go to zero. Okay? However, you can lose multiples of 1x when you're selling options. Flip that over to buying options where you can make multiples of what the option costs, but you can only lose 1x. So putting this in option strategy terms, I believe selling premium about 85% of the time is the correct amount to concentrate on selling premium. So this leaves 15% of the time when the enlightened option trader can buy premium. Why those numbers? Why did I choose 85-15? So to understand this, we have to look at volatility futures. And that's something called the VIX, which we've talked about here lots of times before, but let's review the VIX really quick. A lot of people call the VIX the stock market's fear gauge. It's not really the fear gauge, just simply the cost of hedging. The VIX measures how much market participants are willing to pay to protect their portfolios. VIX is just the implied volatility of the SPX option pit. When the VIX reading is high, meaning implied volatility of S&P options are high, they're forecasting higher volatility. It can indicate that fear is high. It also indicates that people are paying up for protection. When the VIX is low, it generally indicates to me a normal mean reverting market where most folks are feeling pretty complacent. And that's the type of the market that's the 85% of the time we're selling option premium has a tailwind and works. We'll discuss the mechanics of that in just a second. So this is just some academic number I'm talking about, or I had AI write me a script. This is a critical piece of data that professional traders and their algorithms key off of every day. Algorithms use the VIX as a type of weather vane for the market's mood, and traders do too. It can help traders decide when the conditions are right for selling premium versus for buying premium. So most of the time, about 85% historically, the VIX is in a condition, the VIX futures market is in a condition called contango. Okay, now you've probably heard me talk about this before, but during this time, this 85% of the time, the VIX futures market is in a condition called contango. There's a built-in tailwind for option sellers, for premium sellers. Okay, so contango is the normal state of things. And contango is where future volatility is expected to be higher than current volatility. Here's current volatility. Here's future volatility. Future volatility is higher than current volatility. All right. When you sell a covered call, you sell it right here, but then it expires in the current. And then okay, see what I'm saying? You sell it in the future, not really, but then it expires in the current. Well, you're selling high and buying low when the market's in contango. There's a natural slope down that you're taking advantage of. Contango is the normal state of things. It's 85% of the time, right? Covered calls, short puts work great during contango. It's just bread and butter. It's like running up the middle in football, okay? What about the other 15% of the time? What about when the VIX futures market flips into backwardation? This happens when things get crazy and current real-time fear is higher than future fear of the market. The VIX's future term structures down here and the current term structures up here. Suddenly there's a tailwind for suddenly the tailwind that did exist for premium sellers turns into a stiff headwind. Trading in backwardation is where premium sellers get into trouble. It's particularly when the Enlightened trader changes plays, calls an audible. The tailwind is now at the back of option buyers. That only exists 15% of the time. Current volatility is higher than future volatility. Okay, so you're selling premium, you sell it out here, it expires right here. You're selling low and buying high, doing the opposite of what you're supposed to do. And this isn't just like, you know, something. I mean, I use this, and I've used this exact method for years. You might remember a few weeks. You might remember last March, late March and early April. I just quit doing earnings trades. My earnings trades are always short volatility type trades. Anyway, the coast wasn't clear. The market was in backwardation at the time, and the tailwind was at the back of the premium buyers. So during that time, it lasted about 3 weeks. I switched to long volatility trades, and my single biggest win of the year came from a put contract that I rolled down and out 3 times during that time period. That's the deep pass. That's hitting for power. Here's the other thing that pure premium sellers miss. They never get a big outsized win. Their strategy is built on a high number of small wins, which is great. They're consistent, but they have to live with the risk of the occasional big loser. Buying options strategically flips the script. You have small manageable losses, and you have at least a chance of an occasional outsized win. At the end of the year, your total return is made up of short volatility and your long volatility trades. By adapting to the market structure, I can use the entire playbook. I take the singles and doubles when the market will give it to me, but I can swing for the fences, hit a home run when the pitcher's arm is wearing out and he's hanging a curveball across the plate. The system of using contango and backwardation as an indicator is one of many factors that affects the stock market. If no single system, certainly not this one, should be relied upon solely without looking for other confirming indications. The VIX itself is a great confirming indicator, but is far from the only one. For example, another way to get a similar signal, even if you don't follow the VIX, you could decide to exit the market and quit doing short volatility trades when the SPX moves underneath its 200-day simple moving average. This could also help you sidestep major problems in bear markets. Let me ask you, are you only a premium seller, or do you buy premium sometimes also? Let me know what you think in the comments. Happy Sunday from Hill Country, folks. See ya.